Today, my guest is Mansoor Ghori. Mansoor is the co-founder and CEO at Petros PACE Finance. And in just a minute, we're going to speak with him about PACE financing, what it is, and how it can help commercial real estate investors. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. You can like, share, or subscribe. And as always, please leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and that's at Commercial Real Estate Pro Network on YouTube. With that, I want to welcome my guest, Mansoor. Welcome to CREPN Radio.
Thanks, Darren. Appreciate it.
All right. Well, I'm really looking forward to our chance to talk today. And before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I've been in the commercial lending, venture capital, and structured finance world for over 30 years now. We founded our firm Petros PACE Finance in 2011, actually. And really, what it is Petros is a structured finance shop, and really what we do is we create fixed income instruments that we then get rated, securitized, and sold to large institutional investors. PACE is one of those products that we create, and we started the PACE part of it probably 2013, 2014 to really kind of get into the industry, and are now the largest commercial PACE provider out there.
Great. On the PACE, I think that's kind of the main interest as far as kind of what led me to reach out to you. And it sounds like you're clearly, if you're the largest, you're the right guy to talk to about this. For the uninitiated, can you explain what is, just as an overview, what does PACE stand for?
PACE stands for Property Assessed Clean Energy. And what it does is allows people like us to enable commercial property owners to either retrofit or build new properties with more energy efficient upgrades. And it allows us to do that over a period of time, which is much longer than they would get if they got a bank loan. So we can actually do these PACE assessment financings over a period of up to 30 years, the lesser of 30 years, or the weighted average life of whatever's being put in. So when you think about that from a commercial real estate owner perspective, historically, there has not been a lot of energy upgrades to properties because the cost benefit just never made any sense, right? So, the payback periods on a lot of these upgrades are anywhere from, 10 to 20 years or maybe even longer. But the financing that they would get for it from a bank would be anywhere from 3 to 5 years. So the project was always underwater. Now with PACE, it allows us to do this where the project is net positive from day one because we're doing it over an extended period of time. And it's much cheaper than using your own capital. A lot of these commercial property owners want to use their own capital for higher return items, and commercial PACE improvements is not a higher return item. So they'd rather go out and buy new properties or do something else with their money. So this is a great mechanism for them to be able to retrofit those properties and actually be net positive from day one, net cash flow positive from day one.
Well, cash flow positive from day one for a capital improvement project, that's unique. That's not that's
right.
Not exactly the way the conversation usually goes.
That's right.
So talking about energy, is there an audit, or how do we determine
Sure.
what our baseline is? Is there a need for a measurable improvement?
Yeah, so first of all, every deal that we do, there's an energy audit that's completed, whether it be a retrofit project or whether it be a new construction gut rehab project. So that energy auditor will go out there, and for a retrofit project, we'll look at what's currently in there, and they will then look at what is going to be put in there, and they'll do the analysis to figure out what the difference in savings is going to be with the new ECMs. On a new construction gut rehab project, it's hard to do. People use as a baseline typically code, and then they'll look at code and look at ECMs that are either above code or at code to figure out what the potential energy usage is going to be on those new properties. Okay, so but every project does have an energy audit that's completed.
Got it. On the retrofits, if we start with the baseline and the projected improvement is, whatever it is there a time period for monitoring to confirm that we've met that, or is it just the one time we did the calcs and we're good to go?
Yeah, that's a good question, and it depends per state and per program. So there are some programs that require that you continue to do the monitoring to make sure that savings are there. And there's one program in particular, I think it's a Michigan program, where for a smaller transaction, so that's typically less than $250,000. Um, uh, Actually, I'm sorry, if it's greater than $250,000, then there's an energy guarantee that the contractor has to actually give the borrower or the property owner. And what that does is it guarantees that the savings that the energy auditor actually projected are going to be there. And if not, then he's coming out of pocket to make that difference up. But so there are specific programs that make you actually monitor your results, and then others that don't necessarily monitor that from a year-to-year basis. But the borrowers are actually watching to make sure that those savings are there.
Got it. So in the spectrum of energy savings, I guess my first thought would be like heating and cooling, or windows, maybe water. Is there a defined list of projects that are eligible?
So it's not a defined list of projects, but there are a defined list of ECMs. And once again, that changes by program and by state. For instance, in California, there's seismic upgrades that are allowed under the PACE program. And since California is really kind of the only state that has the issues with earthquakes, that same allowance is not used in other states like Texas or Florida or whatever. But in Florida, there's hurricane resistance measures that are included in the program, which are not included in other states. So it is more program specific, but in generalities, there's a lot of the similarities are things like water, things like renewable energy, whether it be solar panels, wind, or some other renewable energy. There's also lighting controls, HVACs, chillers, boilers, windows tinting, and other energy saving upgrades. So there's a big list that is similar, and then for specific states there are some differences, some nuances.
Got it. So if I have a project that I'm gonna, or that's got elements that are that qualify that we can do through PACE. You mentioned kind of the weighted average as far as the length of the payback.
Yep.
So if I've got something that's at 20 years and I've got something that's maybe 7 years and on and on, do they basically just take all those up and come up with an average, and that becomes my length of the payback or the
Exactly. So not length of the payback, but the length of the assessment. So we'll figure out exactly what that length of the average life is of everything being put in, and then that will be the length of the actual assessment. So if it's 17 years, our assessment will be on that property for 17 years. So what that does is it enables the net positive from day one feature of PACE. The reality is if you had a 20-year weighted average life of ECMs being put in, yet your tenor was 10 years, then once again, it's the same concept of getting a 3-year loan for a 10-year payback type issue and you're underwater. So now this kind of stretches it out so that whatever's being put in, you should be able to be net positive from day one because the length of the assessment is the same as what the weighted average useful life is.
Got it. Um, are there like some sweet spot kind of items that you typically see on the, I mean, you mentioned kind of California and Florida being unique with their environmental, you know, issues that they have there, but is there kind of a sweet spot of things that you typically see? Is it kind of lighting and water and that kind of stuff?
I think the majority of what we see is lighting controls. We see HVACs, we see chillers, we see boilers, and we see kind of like window envelope type deals. We have not seen as much solar as we thought we'd see. And that's primarily, I think, because solar so far is a really nice to have, but it's not a have to have. When these guys are looking at their ECMs, they're looking at their capital budgets over the next 3 to 5 years and saying, okay, well, what do we actually have to change out, right? They have to change out their HVACs because they're going to go bad. And if it's in a warm state, guess what happens in the summertime? Same thing with the boilers up in a cold region. They have to get those changed out so that they're not freezing during the winter in Minnesota. So they'll look at the things that they absolutely have to change out first, and then eventually they'll start going and looking at things that will be nice to haves. As we see more mandates like what's happening in California right now for solar. So recently there was a law that was passed where all new construction of commercial buildings have to have solar on them. And those, I think, start taking effect maybe 2021 or 2022. But as we see more of those mandates that are spread across the country, then I think we'll probably start seeing more solar projects. That makes sense?
Yeah, yeah. Where did you say that was was
California.
mandating California?
California, yeah.
Hmm. No, that would certainly drive uh, the demand for more installation of solar, which
Correct.
um, sometimes that's what it takes is some sort of a governmental rule like
Right.
that. Um, so let's talk a little bit about the money. I mean, we've talked about the length of the payback. You introduced in the introduction there about how you raise capital and send. I don't want to put words in your mouth, but basically that the mechanism, I guess, for the financing for the long term financing for this. If I have a project and I'm seeking financing for it,
Mhm.
am I? Is it? Do you go to the originator of the PACE program, or is it available through different mortgage brokers, or how's that?
Yeah, actually, you can come directly to us. So
Okay.
there's, you can come to us directly, and there's, a handful of others that are more national that will be able to do deals for you. But we're the actual lender, right? So if you come to us, then there's no fee in between, the commercial property owner and us, where the property owner has to pay the broker typically a fee. So if you come to us, you kind of skip that routine. And we actually do the structuring, the underwriting, and the funding of the transaction.
Okay. And can you also do, like, if it's a new purchase, and I've got essentially just for round numbers, say it's $1 million building, and traditional financing would require that I come up with 250 or 200 to $250,000 worth of down payment.
Mhm.
Can you do the balance of the financing?
So the way that it works in PACE is we've got um, limitations. So we're typically not more than 30% or 25% of the market value of that property if there is a mortgage on the property, and we can go up to 35% if there's no mortgage on the property. So let's just say it's a $10 million building. we can finance, and there is a mortgage on the property, we can finance up to $2.5 million on that property. Okay.
Okay. And how, so tell me on the capital stack, is that now, is that a lien against the property, or how does that work in there
Yeah,
with the?
so that's a great question, because that's kind of comes to the essence of what PACE is. So the PACE is actually considered a property tax assessment. So when we close the transaction, what happens is it gets recorded at the county recorder's office, and it is a property tax lien against that property. Okay. Now, that does not restrict any senior lender from doing what they need to do on the property. So if they're delinquent with the senior lender has all of the remedies that are available to it to take the property back, go sell it, and get their money out. Our PACE money stays on that property, so it transfers from one owner to the next automatically, and it stays there as the PACE assessment. So, um, uh, so for any 1 year, our payment is looked at as a property tax. So it's included with the property tax that the borrower pays normally, right? Um, so that's how it works.
So I've got my normal property taxes. Now I've
Mhm.
added some PACE financing.
Correct.
Would, I guess, would that payback be essentially just the amortized payment of whatever the length of term of the amount of financing that I uh,
Correct.
collected from the for the PACE?
That's right. So if it's if it's a 20-year loan, that assessment is fully amortized over 20 years. Okay. And
Okay.
every year the payment stays exactly the same. So that does not change. That does not change, unlike the normal property tax, which may go up or down based on the value of the property. The property tax assessment for PACE stays exactly the same over the life of the assessment.
Okay. So the PACE is a separate assessment from my normal property taxes,
Yeah,
correct?
there's two line items. One will be your normal property tax, and then the second will say, PACE assessment.
Okay. So the PACE assessment is frozen for the life of that payback, correct?
Correct.
And is that independent then of the balance of my property tax? Is that's still
Yes.
subject to whatever the, okay,
Yep.
gotcha. Um, on the you talked about the return. Um, does using the PACE, and you talked also about how the lenders view it in that it's kind of separate. Does that lessen my need to bring capital to the deal then if I'm utilizing PACE financing for, like on a like we're just illustrating, like on a typical deal, if you had say $1 million or $10 million and you needed to bring 20% down payment
Mhm.
to get into the property, and the bank lends 75 or 80% of the balance there. Um, and you mentioned you could go up to 25%. Is it possible that could be my down payment or equate to my down payment?
That's a good question. So PACE is generally used to replace either equity or mezzanine debt, or some other types of financing. So in a situation like you had just mentioned, it wouldn't replace all the equity. I mean, I think everyone wants to make sure that there's at least some skin in the game by the property owner, whether that number is 10% or a little bit more, or a little bit less. That's something that has to go through underwriting. But everyone wants to see at least some money in there. But if you're looking at a situation where you have to come up with 20, 25% equity on a transaction with a senior lender, PACE can certainly replace some portion of that. So you would come up with less money and use PACE for that difference.
Got it. Got it. But it certainly sounds a lot more attractive than the traditional, whether it be a bridge loan or
Right.
or some sort of construction financing.
And the other aspect of PACE is that it does not accelerate and it is non-recourse to the property owner.
All right. Um, we talked about these different kind of line item projects and stuff, and my hunch is that, or I guess my thought is that there's likely some of these projects that could be partly PACE, partly non-PACE. If you're doing a rehab of a property and you were upgrading, um, these certain elements, there'd still be a balance of things that were outside of the PACE. Is that typically the case?
Yeah, we'll see that on almost every project we do. There's a portion that's PACE and there's a portion that's non-PACE. So in a situation where there is a senior lender um, that's doing the non-PACE and the PACE lender doing the PACE portion, there's draw schedules that are agreed to upfront on the items that are PACE eligible and the items that are non-PACE eligible. The senior lender then does the draws based on the items that are non-PACE, and we do our draws based on the ECMs that are PACE eligible.
Got it. Um, is there a minimum amount or a maximum? You mentioned the percentage um, of the market value, but is there a minimum amount that PACE works for, or that you can do?
So there's a minimum amount for us. We typically will not do a transaction below $500,000, but there are other PACE providers that will go below the $500,000. On the upside, we don't necessarily have any limits. So we've got transactions that are out there with term sheets that are, a couple $100 million to $500 million. So that the upside is unlimited as long as it fits the ratios that we talked about.
Got it. Um, we talked a little bit about the transferability of the PACE financing. If I have PACE financing in place and I've got, say, 10 years left on um, my PACE financing, and let's just say for round numbers that the balance owed is $1 million,
Yep.
how is that reflected in a sale and subsequent sale to a new buyer?
That is a question that really has to be negotiated between the buyer and the seller. So what I'll tell you is that that $1 million will have a cost to it, which is the typical, which is your PACE assessment cost every year. But putting those retrofit ECMs in there should give you also a reduction in utilities. So theoretically, the savings from the utilities should offset the additional cost on the assessment. And so it shouldn't really affect your NOI. So your property value should theoretically be the same or maybe even higher. But there's also deals I've seen where they take the assessment into consideration as part of reducing some portion of it in the purchase price. So it's all a negotiation based on what's kind of put in and what it does to the NOI and cap rates and those kinds of things.
Well, it still seems like though from a performance thing, if the improvements are done right away, and I'm getting the benefit of those right away without going negative for multiple years waiting for the payback, that the project owner or the seller is ahead, and I would assume that the buyer would recognize that if they're unless they're at the tail end of these things and they're nearing the need for a replacement again kind of thing. But I would think that there would be some sort of recognized benefit there.
Yeah, and I've seen transactions with that concept for sure. And that makes a lot of sense because that's the way that we look at PACE is, look, because you're actually saving more than you're paying, that should not negatively affect your NOI. It should be positive to your NOI. And so your NOI should go up. And if you attach a cap rate to your increased NOI, your valuation on your property should go up, right?
Right.
So that's certainly one of the arguments there. And but like you said, if you're down, 10, 15 years into this thing and you're kind of at the very tail end, maybe more of the savings were at the front end versus the tail end, and that may not be the case at the very end.
Got it. Um, what have you seen any resistance to PACE financing, or
So that's a good question. So in the early years of PACE, there was a lot of resistance from senior mortgage holders, primarily because they'd never seen PACE before. This was kind of a new concept. They didn't really know how it works, and they didn't really understand, what the remedies were in a situation where there was, issues from their perspective with the property owner. And over time, over the last 3 or 4 years, what we've seen is there is a lot more now understanding of what PACE is and how it fits and how it works with a senior mortgage. And we've seen less and less and less resistance. So other than that, we're seeing, a lot of eyes opening from the commercial property owner perspective because they'd never heard of PACE. And they're now looking at this saying, wow, that would be great in our cap stack, especially the guys that are doing the new construction gut rehab projects. Because as you know, banks are getting tighter. We're kind of at the end of a cycle now. So loan to cost ratios from banks have tightened. You've got the EB-5 program that's not as robust as it used to be due to political issues. So there's more gap in the cap stacks for those new projects that need to be filled. And PACE is a perfect kind of step to put in there to kind of fill that gap in that cap stack.
I'm an insurance broker, and I mean, the capital improvements are just ongoing as far as what insurance companies are looking at.
Right.
They're recognizing a lot of the claims that they're paying are related to these older systems, and as such, a lot of the carriers are kind of narrowing their view of what a desirable risk is, and they're usually saying something that's 30 years or newer. And this is, to me, this is like just the opportunity for somebody that has a property that not only are they, I mean, if they don't take care of it through something like PACE, we've already talked about the ongoing costs and the negative return, or how many years it takes to pay it back.
Right.
This could have multiple benefits as opposed to just the you're getting your systems replaced. B, you've got long-term financing, which
Right.
makes you cash positive, and now you can make your insurance company happy. So
that's right. So I mean, I think you hit on some key points here. So one of the things that property owners do is they're looking at either their deferred maintenance that they've got to do, and they're looking at their capital expenditures for each year going forward, and they typically don't like to go beyond 1 year at a time because it's just a lot more capital that they have to kind of invest. What PACE does, it allows them to look longer than 1 year, allows them to look through, 2, 3, 4 years down the road, and pull all of those ECMs that they're going to do over that time period into one holistic project that they can do day one, because of the fact that there's long-term financing and it should be net positive from day one.
No,
right? So all of a sudden their properties are getting improved much quicker than 3, 4 years down the road.
Yeah, trying to finance it out of cash flow, and you basically are at zero or negative, or
right,
or waiting for everything to be done, and it's just ongoing because you can't get it all done. Yeah,
right.
no, that's great.
Yeah.
Any advice to a real estate investor that's looking to get started, or looking for PACE? Is there something that they should look for? Or? be aware of?
I think the way they should do it is, they should get a hold of people like us, and walk through what they're trying to do. We have folks here that can kind of help them through what a project would look like and what they have to do, what they have to pull together to at least get an indication of whether that's a deal that can get done through PACE or not. And if it's not, then what are the things that are missing? But that would seem to be the easiest way to do it.
Got it. Hey, Mansoor, if we could, I'd like to shift gears here for a second.
Sure.
As I mentioned to you, by day I'm an insurance broker, and we work with our clients to assess risk and try and manage the risk. And there's a couple different strategies we typically consider. The first is we ask, can we avoid the risk? The second, if we can't avoid it, we look to see if we can minimize the risk. And if that's not a possibility, then we look to see if we can transfer it. And that's what an insurance policy is. It's a risk
Right.
transfer mechanism. And so I like to ask my guests if they can take a look at their environment and how they are working with investors and what they see, and if they can in that identify what they see is the biggest risk. And so if you're willing, and just to be clear here too, I'm not necessarily looking for an insurance related answer, um, kind of a blank slate. You can define it however you choose. But again, if you're willing, I'd like to ask you, Mansoor Ghori, what is the biggest risk?
So I'll kind of address this from a PACE perspective, because I think from more of a higher level perspective in terms of the economy, et cetera, um, I don't necessarily see a downturn in the economy as a risk to the PACE industry. I actually think that is an opportunity, because all the rest of the money in the cap stack is going to get tighter, and PACE will provide an opportunity for them to help them get projects done even in a downturn. I think from a PACE perspective, the thing that I worry about most is that we have to make sure that the way that PACE deals are being done, they're being done with diligent underwriting. They're being done in a way where these things can get rated, securitized, and sold to investors. If there are people that come in and don't do it correctly, I worry that there could become issues in the PACE industry. There could be deals that blow up. If you think about PACE in historically, there hasn't been any major blowups in PACE, in commercial PACE, since the history of PACE, right? That's on the commercial side. I'm not saying that so on the residential side, but on the commercial side, they're being underwritten like normal commercial loans. And so they're a lot safer from that perspective. Our worry is that people are going to come into the space as it becomes more active and starts growing, and they do it incorrectly. So we've tried to find ways to mitigate that. So we created something called the CPACE Alliance, which is an industry group of pretty much every major commercial PACE lender, the service providers that are part of the PACE, the commercial PACE area. And what we're doing is we're creating templates on how to underwrite, templates on how to administer, templates on what the statute for these programs should look like in each new state, so that there is a box that everyone can play inside and not go outside the box. Does that make sense?
No, it's absolutely genius because just like what you were describing there is it hasn't blown up. It only takes one rogue operator to see the opportunity and exploit something that wasn't intended and run
Correct.
ripshot over it, and before you know it, it's blown up and it's not available for anybody.
That's
So
right. That's right.
so no, that's really wise of you, and I applaud you in your efforts with CPACE, and I would think that also definitely keeps you at the forefront as far as the thought leadership goes, as far as the PACE financing, and that would continue to make you guys a noteworthy resource in that. So
Yep.
that's great.
Yep. Absolutely. Yep.
So Mansoor, where can the listeners go if they would like to learn more or connect?
Sure. So our website is www.petros-pace.com.
Got it.
And go there. There's a lot of information about PACE, how it works for different types of projects, different types of properties. We've got case studies there. We've got a phone number. You can get a hold of us. We can kind of walk you through what it looks like. You can see what our background is. It'll give you a good perspective on what PACE is and how it works.
Awesome. Mansoor, I can't say thanks enough for taking the time today. I've enjoyed it, learned a lot, and hope we can do it again soon.
Sounds great. Thanks, Darren. Appreciate your time.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.